Welcome back to the deep dive. Today we're really getting into something interesting, not just the usual quarterly report stuff.
No, not at all.
We're looking at DoorDash's Q3 2025 earnings. And well, the story isn't just good numbers, it's about how that success is actually funding a huge strategic shift.
Yeah, a really aggressive pivot, you could say. They're using this strength to move beyond just delivery.
Exactly. From, the top delivery app to becoming this.
Yeah.
What they seem to be aiming for is the essential local commerce operating system.
That operating system idea, it's
Right.
spot on, because that's where the big money is going. Q3 was strong, really strong.
Fourth straight quarter of accelerated growth, right?
That's right. And that gives them the confidence, but also the actual capital to make some pretty fundamental changes. We're talking about several $100 million more
Right?
in investment for 2026.
Wow.
And this isn't just like tweaking budgets, it's launching major multi-year projects basically right now.
Okay, so let's unpack this for you, our listener. Our mission here is to figure out exactly where those hundreds of millions are headed. It seems to fall into what? Three main areas.
Pretty much. Three big buckets. First, rebuilding their global tech from the ground up. Second, dealing with their much bigger international scale, especially after Deliveroo.
And third,
And third, building out completely new physical services. Think fulfillment, automation, stuff like that.
got it. So before we dive into those big bets, we need to understand why they feel they can make them, the justification.
Exactly. This kind of spending, it's going to hit short-term cash flow, obviously. So you need to look at the Q3 numbers, the core business health. It all ties back to their main goal, maximizing long-term free cash flow per share.
Okay, so give us the highlights. What makes the core business so strong right now?
We'll look at the scale first. Total orders grew 21% year over year. That's 776 million orders.
Just massive volume.
Huge. And the marketplace gross order volume, the GOV, grew even faster. 25% year over year, hitting $25 billion.
25 billion?
But here's the really key part, the profitability. Adjusted EBITDA jumped 41% year over year.
41%.
Yeah, $754 million. That's 3.0% of GOV. So it's not just growth, it's profitable growth. And that's a position, frankly, that many competitors are still struggling to reach.
Okay, hang on though. If the goal is maximizing long-term free cash flow, why spend so much now? Doesn't that, directly reduce cash flow in the short term? Seems a bit contradictory.
This seemed like a contradiction on the surface, but it's about strategic necessity, really, and using their current strong position. They believe, it seems, that if they don't make these foundational investments now, like building that unified AI-focused platform, they might miss the window.
Ah, so competitors could catch up, or the tech landscape shifts.
Exactly. They're using that 41% EBITDA growth, that financial strength, almost like a shield. It lets them take on these huge, complex projects that others who are maybe still fighting just to break even simply can't afford. It's like an aggressive defense move. Build the moat, wander while you can.
Okay, that makes sense. Spending now to secure the future position, sacrificing a bit of immediate cash for long-term dominance. And this is all built on a really strong U.S. base, right?
Absolutely essential. The U.S. restaurant business, their bread and butter, actually saw its marketplace GOV accelerate. It hit the highest year-over-year growth rate they've seen in over 3 years.
Wow, even at their scale.
Even at their scale.
Yeah.
And user growth, the monthly active users, beat expectations too. So they're adding customers efficiently. They estimate they generated something like nearly $24 billion for merchants and Dashers just in Q3.
24 billion in one quarter.
Yeah. And they expect that number, platform-wide, to cross $100 billion in 2026. That's the powerhouse funding this whole OS strategy we're talking about.
That kind of domestic engine definitely lets them take risks elsewhere. So let's talk about those other areas, the new verticals, non-restaurant stuff. Is that segment pulling its weight enough to justify all this investment focus?
Well, pulling its weight might be strong, as it's still negative overall, but the momentum is definitely there. Very strong, actually. Growth is coming from all the right places, more users coming in, those users ordering more often, and spending more per order.
Okay, so the usage patterns look good.
Right. And what's really interesting is, even though the segment as a whole isn't profitable yet, the unit economics are improving, both compared to last quarter and last year. So they're showing they can make these new areas work and make them cheaper to operate as they get bigger.
I like the specific examples they gave. It really shows they're thinking way beyond just, delivering pizza or groceries. What were some of those surprising growth areas?
Yeah, beyond the obvious, like groceries, they mentioned things like pets, health and beauty, and even home improvement doing really well.
Home improvement.
Get this, they gave a specific example. The platform is now delivering thousands of pounds of mulch per day.
Wait, mulch. Like
Yeah.
big bags of garden mulch, thousands of pounds a day.
Thousands of pounds a day.
That's not a typical delivery item. That requires planning, the right kind of vehicle. You can't just stuff that in a regular car easily.
Exactly right. And that tells you a lot. It shows they're seriously moving into heavier, maybe scheduled, definitely non-food local commerce.
Hmm.
It means their logistics systems, their algorithms, have to handle totally different kinds of items, weights, vehicle types,
Mm-hmm.
which feeds right back into this whole idea of building a flexible multimodal logistics OS.
Okay, that mulch example really lands the point, and it leads us right into the global picture because that scale just exploded with the Deliveroo deal. That closed October 2nd, right after Q3 ended.
That's right, October 2nd. And it was a massive deal, 2.8 billion pound equity value.
Huge. So what does a combined company look like now globally?
It's a completely different map. Post-acquisition, you're looking at over 50 million monthly active users.
50 million.
Yep, across more than 40 countries. And the annualized marketplace GOV is now over $100 billion. This isn't just about winning in the US anymore, it's a global platform race.
So with Deliveroo specifically, what's the plan? Are they just trying to squeeze profits out of it immediately?
Interestingly, no.
Yeah.
They said the business was actually in better shape than expected.
Oh, really?
Yeah, which apparently gave them the green light to invest more right away rather than just focus on cost cutting. The priority seems to be improving the product, focusing on keeping users and getting them to order more often and improving the unit economics, likely by bringing in best practices from their Wolt operations in Europe.
Okay, so investing for the long haul there too. What are the financial expectations then?
They expect Deliveroo to add about $45 million to Adjusted EBITDA in Q4 this year, and then around $200 million for the full year 2026.
$200 million for 2026. Given the purchase price and the scale, that feels, well, maybe a bit low. Does that mean the real payoff is much further out, or are they baking in a lot of investment cost into that figure?
It definitely means the payoff is backloaded. And yes, that $200 million figure includes the increased investment they plan to make. They're deliberately choosing to reinvest in the business now to make it stronger long-term, rather than maximizing profit right out of the gate.
Makes sense.
Plus, down the road, they expect to get significant savings by merging the operations of Wolt and Deliveroo in Europe onto, presumably, one system. But that integration takes time, and it costs money up front.
Right. Combining two big European players across dozens of countries, that integration sounds like a massive challenge, especially for their tech systems.
Oh, absolutely. It creates a huge amount of technical complexity, like technical debt, but on a global scale. And that brings us neatly to the biggest investment bucket of all, the new global tech platform.
This is the core of that local commerce OS idea, right?
Exactly. This is the big one. A multi-year foundational overhaul of their entire technology stack.
Why now? Why their urgent need to rewrite everything?
Well, it's kind of a victim of its own success problem.
Mm-hmm.
They currently have 3 separate main technology systems, or stacks.
Mm-hmm.
The original DoorDash one, the Wolt one they acquired, and now the Deliveroo one.
3 separate systems.
Yep. And they explain that means every time they want to launch a new feature, even something basic like improving the checkout process, they essentially have to build it and deploy it 3 different times, one for each system.
Wow, that sounds incredibly inefficient, just burning engineering resources.
Totally. It's like trying to maintain 3 operating systems at once. The solution they're building is a single, unified global stack. The idea is you build a feature once, and it goes live everywhere, for everyone, simultaneously.
Okay, unification makes sense, but they also talked about it being AI native. That sounds like more than just merging code bases. What does that really mean? This seems to be where a lot of that money is going.
It's much deeper, yeah. AI native means they're not just adding AI features onto the old system. They're rebuilding the fundamental architecture around AI and machine learning. It changes everything. How software is developed, how it's tested, how it's deployed.
Oh, so?
It seems to shift the role of the engineer. Less about writing specific lines of code for every little function, and maybe more about building, training, and managing the AI models that then drive the platform's intelligence. It's about future-proofing, building a system that can learn and adapt much faster.
So the payoff is speed and efficiency in the long run.
That's the goal. Ship features faster, have a much leaner cost structure eventually, and critically free up all that engineering brainpower that's currently spent just keeping 3 systems running.
Freeing them up to solve new problems.
Exactly. Like optimizing deliveries across 40 countries or figuring out the logistics for, delivering thousands of pounds of mulch autonomously.
Right, back to the mulch. And okay, they mentioned a cost spike in 2026 because of this. They called it temporal expense. Sounds like corporate speak for it's going to cost a lot right now.
Pretty much. It's necessary pain, though. Think
Yeah.
about it like changing the engine in your car while you're still driving it down the highway.
Okay, tricky.
You have to pay for the new engine, pay the mechanics, and keep buying gas for the old engine until the swap is done. They're running the old systems in parallel while building the new one. That means paying for extra cloud computing, extra teams, duplication, until they can finally switch over. It's expensive, but unavoidable for this kind of transition.
Okay, so a massive digital overhaul. Let's shift gears now to the physical world, the new services and the automation side, where the OS meets the actual street, you could say.
Yeah, this is where it gets tangible. A big push here is something called DashMart Fulfillment Services.
DashMart Fulfillment, what problem is that solving?
It tackles a really fundamental issue for non-restaurant delivery, knowing what's actually in stock at the store, inventory accuracy.
Right, we've all had that happen, right? Order something, then get a call saying, oops, sorry, we're out. Why is that so hard for retailers?
For many stores, especially smaller ones, their digital inventory just doesn't match the physical shelf perfectly. Someone might need to physically check. And customers, especially if they're paying a premium for speed, get really frustrated by errors, substitutions, or cancellations. For retail delivery to work smoothly, you need near-perfect accuracy.
So if the stores can't guarantee it, DoorDash steps in.
That seems to be the play. They're offering an end-to-end service, warehousing, managing the inventory, picking and packing, the whole fulfillment process. The goal is to hit that near-perfect accuracy.
And the bigger picture.
The bigger picture is enabling any retailer, big or small, even if they have zero logistics capability themselves, to offer super fast same-day or even same-hour delivery. It essentially turns every local store into an online, on-demand store. That potentially unlocks a huge amount of new products, new selection, onto their platform that just wasn't accessible before.
That could be huge for selection beyond food. Okay, now the really futuristic stuff. Automation. The autonomous delivery platform. What's the vision there?
They talk about a multimodal world, which means they don't see it as just one solution, like only drones or only robots. It's a mix.
A mix.
Yeah, human dashers doing complex deliveries, maybe different kinds of autonomous vehicles for different routes, land robots, maybe aerial drones eventually, vehicles they operate themselves, vehicles run by partners,
Yeah.
a whole ecosystem.
And they mention a specific vehicle, the Dot.
Yes, the DoorDash Dot. They described it as the first autonomous vehicle purpose-built for delivery that's designed to operate on roads, sidewalks, and bike lanes.
Roads, sidewalks, and bike lanes. That sounds incredibly complex from an engineering and, well, a legal standpoint.
Hugely complex. That's why it needs significant upfront investment. Manufacturing these things, setting up partnerships with cities, navigating regulations, it's a massive undertaking. But they specifically said 2026 is when they expect to start commercializing some of these autonomous efforts.
Okay, so autonomy is moving from R&D to actual deployment next year. One last area we should touch on.
Okay.
They're expanding beyond just delivery, right? This going out idea.
This is about using the platform to connect people to local businesses, not just bring things from them.
So like reservations.
Exactly. Things like restaurant reservations, maybe rewards for dining in stores, and integrating that CRM platform they own, 7 Rooms. The idea is to give restaurants, especially, tools to manage their customers and fill their tables, whether that customer is ordering delivery tonight or planning to dine in next week. It makes the platform more valuable, even when no delivery is happening.
Makes the whole system stickier for the businesses.
Okay, wow. We've covered a ton here. Record Q3 driving massive investment in global tech, international integration, new fulfillment, autonomy. Let's try to boil it down. What's the core takeaway here? What does this all mean?
I think the core insight is pretty clear. They're using their current financial strength growing fast, even at a huge scale, to fund these really deep, foundational, long-term projects. They're not just patching holes.
They're building what they hope will be the dominant, resilient operating system for all local commerce for the next decade or more. And that system really rests on 2 main pillars: Integrated global scale, thanks to Wolt and Deliveroo, and increasingly autonomous AI-powered logistics.
So for you, the listener, thinking about all this, that push towards AI native tech and multimodal autonomy raises a really interesting question, doesn't it?
It really does.
Given this massive foundational rewrite they're undertaking, how does the role of the human dasher change? Is it less about just driving from A to B and maybe more about managing a fleet of autonomous units for the final handover, overseeing the process?
And what about the engineers? Does their job fundamentally shift away from traditional coding towards becoming trainers and curators of the AI that actually runs the whole show? It makes you wonder how different the whole structure of local commerce might look in just, say, 3 years.